What happens when you need to fix a damaged credit score or build a brand new credit profile from absolute scratch, but every traditional lender turns you away because you lack established history? It creates a frustrating loop where you need credit to get approved for credit, yet no bank wants to take that initial chance on you. This exact roadblock leads thousands of people to consider alternative tools like Kikoff, an app designed to act as a stepping stone toward financial approval. The core question is whether paying for Kikoff in 2026 makes genuine strategic sense for your wallet, or if you are simply throwing money at an artificial temporary metric that fails to translate into real-world buying power down the road. To evaluate Kikoff properly, you have to look closely at how the entire system functions under the hood. When you sign up for the basic plan, Kikoff opens a digital line of credit in your name, often valued at $750. Crucially, there is no hard credit pull required to open this account, meaning your existing credit score takes zero damage from an inquiry penalty when you apply. You do not receive a physical card that lets you buy coffee or gas with this basic line. Instead, that line of credit is locked directly inside the app, and you pay a flat monthly fee, such as $5 per month, to maintain the service. Kikoff then reports that monthly payment as an active, on-time installment, or revolving credit line to the major credit bureaus, specifically Equifax, Experian, and TransUnion. Because 35% of your total credit score calculation depends entirely on your payment history, having a consistent record of positive on-time monthly payments starts adding favorable data points to your report almost immediately. Furthermore, adding a fresh revolving line of credit with zero balance increases your total available credit limit. That increase automatically drops your overall credit utilization ratio, which makes up another 30% of your score. On paper, this structure addresses the two largest individual factors that dictate whether your score goes up or down over time, making it look like a seamless shortcut. However, relying solely on this metric creates a dangerous misunderstanding about how real-world lending works. While seeing your three-digit score climb 50 or 80 points on a free tracking app feels like instant success, bank underwriting algorithms look far deeper than just a single number. When you eventually apply for an actual auto loan, a traditional mortgage, or an unbacked rewards card, human underwriters and automated risk systems examine the depth and substance of your credit file. They see that your score boost comes from a restricted microline of credit rather than a traditional bank taking a genuine risk on your repayment ability. A high credit score paired with an extremely thin file consisting only of synthetic credit builder apps often results in unexpected rejections or much higher interest rate offers than you anticipated. Another critical point of caution lies in what happens when you decide to stop using the service. If you cancel your Kikoff account after a few months, that revolving credit line closes completely. Closing an active account instantly removes that available credit limit from your overall calculation, which spikes your credit utilization ratio if you carry balances on other cards. It also freezes the age of that line, which can temporarily drag down your average age of accounts over time. Many users who open Kikoff to get a quick temporary bump suffer a sudden score drop the moment they close the account, leaving them right back where they started because they never built a foundation of real independent credit products alongside it. This risk becomes even higher if you forget about the subscription fee and miss a payment. Because Kikoff operates as a formal credit line, a missed or severely delayed subscription fee gets reported directly to the credit bureaus as a delinquent payment. The very tool you bought to repair your credit profile can accidentally inflict a severe, multi-year negative mark on your report over a missed $5 charge. The most effective, actionable way to use Kikoff in 2026 is treating it strictly as a short-term temporary training, rather than a long-term strategy. If your score is stuck in the low 500s or you have zero credit history, opening a basic account for 6 to 12 months can establish the baseline momentum required to cross critical threshold lines. But to turn that momentum into real financial progress, you must pair it immediately with traditional financial habits. Within 3 to 4 months of consistent reporting, apply for an entry-level secured credit card from a reputable bank that offers an automated path to graduate into an unsecured card. Put a small recurring bill, like a monthly streaming service, on that secured card, turn on automatic payments, and let it build genuine, unassisted payment history. By treating Kikoff as an initial springboard to get your foot in the door with real banks, you avoid falling into the trap of paying permanent subscription fees just to keep an artificial score inflated. Focus on building real credit lines that transition into no-fee cards. Keep your balances close to zero and pay every bill on time. That is how you build a thick, resilient credit profile that actually gets you approved when it counts.